everyone, welcome to another lesson from Lesson Up Squad. And today we will be continuing with Notes to Financial Statement. This is a little bit more advanced video than the previous two, so hang in there. If you haven't watched the first and second video, I'm just going to link it above. Please watch it. And yeah, let's get to learning. So last week we've been learning the income statement, the notes to the income statement, the balance sheet, and the notes to the balance sheet. And today we'll be learning how to make certain adjustments on the income statement and balance sheet that you commonly see. We'll also be looking at both the journal and the accounting equation impact. So this is the question we are dealing with today. You will see that I've highlighted important information on the question, for example, the date and the required, which is to prepare the income statement. Another thing I would like you to take notice of that this is a pre-adjusted trial balance, which means that none of the adjustments have been done yet and you have to do the adjustments. So you have to pass the journal entries, and thereafter you would be able to put these amounts on your income statement and balance sheet. If you're looking for an example of a post-adjusted trial balance, please look at our previous example. So when you're doing adjustment question and your question needs you to say prepare an income statement, and so obviously they're not telling you to prepare journal entries and now you have to prepare an income statement, but you've got these adjustments. So how do you deal with that? So firstly is always to draw your format. I can't emphasize how important it is to draw your format so that you have a guidance. Number two is to bring down all the balances that you have in your pre-adjusted trial balance just next to the amount. So open a bracket next to the account name and bring down the value from your trial balance. Number three, identify the accounts for which your adjustment will impact. Number four, complete your adjustments. And then number five, put in the final value in your amount column. Also remember, when you're doing your adjustment, you need to be mindful that you need to think of plus and minus and not debits and credits when you're doing your adjustments. Your debits and credits are only to be thought of if you're doing your journal entries or if you're doing a T account. But if you're doing adjustments directly on your face of the financial statements, you need to think of plus and minus. Also remember, it's very important that you do these adjustments on the face of the financial statements, because if you do not do that, you'll end up losing marks most likely. So here's our first adjustment for the lesson, and that adjustment relates to accrued expenses, which is the cell phone account for 800 Rand for February was received after the end of the financial year. I've done a full video on accrual, so if you still are unsure about accruals, please watch the video. But for this purposes, we've now got the adjustment. We've identified this as an accrued expense because we have not yet paid this expense, but it's an expense that needs to be accounted for this year. So what do we do? Remember, your income statement needs to tell you your story for the current year. You are 800 short in your expenses this year because you have not yet accounted, you have not received your bill. So you would actually add 800 Rand of cell phone expenses, and your accrued expense, which is a liability, you will now have a credit for your accrued expense. So if they had asked you to prepare a balance sheet, this is where you would actually use this portion. But because they've only asked you to prepare an income statement, you need to make sure that 800 Rand of expenses is added to your cell phone account. I also want you to take notice that yes, we should have a debit and credit for every adjustment we make, but that does not mean that you need a plus and minus. Both the adjustments can be a plus, or both the adjustments can be a minus, or both the adjustments can be a plus or a minus depending on the accounting equation. In this case, you're adding 800 expense and you're adding an 800 liability. So the next adjustment we'll be looking at is drawings. What is drawings? Drawings is when an owner takes out anything from the business. That can be money, trading stock, vehicles, anything and everything that an owner would take out of the business is known as drawings. So here we've got an example where the owner took goods for own use, 500 Rand at cost. So what do we have to do? So firstly, we know this is drawing, so we have to increase the drawings. What he took was trading stock, so we actually have to decrease the trading stock, therefore it would be a minus. You can use the dealer rule or any other rule to be able to understand how to debit and credit, but for this purposes, it's very important that you think of plus and minus. My next adjustment that I want to do is my income received in advance. So income received in advance is any money that you've received for work that you have not completed for the year. For example, rent was received for March 2012. Total rent received was 156,000. Remember our formula from our accrual video, what you want over what you have. You can watch the video, I'll link it above if you need more information on the formula and how accruals and income received in advance works. So now you know for this question, you've received rent for March. Your year end is February, so you've received rent for 13 months instead of receiving rent for 12 months. Therefore, you need to remove rent. You've received too much of rent. Therefore, you would subtract it out of your rent income and you would add it to your income received in advance as a liability. The next adjustment I'd like to do relates to bank reconciliation. The adjustment is as follows. The bank statement was received and the following has not yet been processed. Interest on favorable bank account and a deposit by S. Smith. You will know from our bank reconciliation lesson that interest on bank account can only be known when you've received a statement, and also if a deposit has been made, you would only know once you've received the bank statement. So what do you do in this case? So once again, we identify the accounts that is impacted by the adjustment, which is number one, on the first transaction, it's interest and bank. On the second transaction, it's debtors and bank. So firstly, you would increase your interest income and you would increase your bank account. And in your second adjustment, you would increase your bank and increase your bad debts recovered, which is a credit also in your income statement because that is what has been affected. So the next adjustment we will be doing is the prepaid expense adjustment. It's very important to understand what prepaid expense is. A prepaid expense is an expense that you have paid already in advance. So your adjustment here says an annual insurance contract of 30,000 Rand is paid on 1st May of each year. Your financial year end is Feb, which means you pay each year in advance for a few months. Remember our formula, what you want over what you have, otherwise you can refer to our previous week's video, which I will link. Our income statement once again needs to tell us 1 month story. The accounts that are impacted by this is your prepaid expense and your insurance. You need to remove insurance out of your income statement because you are not paying only for this year, you're paying for the next financial year, and therefore you will reduce your insurance by the 5,000. Another common adjustment that you will have to make is debtor returning stock. A debtor M. Maseko returned stock with a selling price of 1,400 and a cost price of 840. So when you receive returned stock, there are two transactions that you have to do. You have to reverse the sale and you have to reverse the cost of sale. So now let's talk about reversing the sale. If you're reversing the sale, you're automatically going to reduce your sale by 1,400 and therefore you're going to also credit your debtors by 1,400 because you no longer owe them that money. If you're reversing the cost of sale, you're going to reverse 840 out of your cost of sales because if you haven't sold something, you can't have a cost of that item in your income statement, and you're also going to increase your inventory by 840. Once again, take notice, in this example, you've got a minus and minus on both the transaction and you've got a minus and plus in both the transaction. So once again, you will have to have a debit and credit, but it does not mean that it would become a plus and minus automatically. You need to think about what is impacted and what was the effect of the transaction on the line on your account. A bad debt loss adjustment. If you've got a bad debt loss adjustment, the two accounts that are affected by your bad debt loss adjustment is your bad debt loss and your debtors. because they no longer owe you the money. You have to remove them out of your debtors. So in this example, we've got 800 has been received from an insolvent estate of a debtor. This has already been recorded in the CRJ. Because this has been recorded, we don't take any action on this. His total debt was 1,200. The balance must be written off as irrecoverable. So the irrecoverable value, which you will never get back, is the 1,200 minus the 800, which gives you your 400. Your accounts that are affected are your bad debt lost and your debtors control. So you increase in your income statement your bad debt lost by 400 Rand, and you decrease your debtors by 400 Rand, which is your credit, because you are never going to receive that money. Our next adjustment example is of accrued income. So accrued income is income that you have not yet received, but you should have received for this year. Commissions on the sale of shoes is still owed by BB Suppliers. The shoes were sold for 5,000 Rand and the commission due is 20% of the selling price. The account impacted here are accrued income and as well as commission income. So remember, we need to now add 1,000 Rand into commission income, which is 5,000 Rand times 20%, and accrued income, 1,000 Rand. Once again, you've got your debit and credit, and you've got a plus and a plus on both sides. So another common adjustment that you're required to do is related to loans and interest. And here we have an example where interest that is capitalized. What does it mean that interest is capitalized? It means that interest is added to the loan account. Versus when interest is not capitalized, it means it's not added to the loan account. When interest is capitalized, your journal entries would be debit interest expense, credit loan. You're adding it to your interest. And if interest is not capitalized, it would mean you would debit your interest expense and you would credit bank or accrued expenses. So here in this example, we've received a loan statement from XYZ Bank. The amount owing to the bank was 336,000 on the 28th February. Interest has been capitalized. You have your balance at the beginning of the year. You've got your balance at the end of the year. So you can see that the balance, because interest has been capitalized, interest was added to the loan account. So the difference between the balance that you have at the beginning of the year and at the end of the year is actually your interest that was added. So your journal entries would be interest expense, you add your 36,000 Rand of interest expense, and loan, you would also add 36,000 Rand because that is the amount that was added to the loan. So here's another example where interest is not capitalized. This is interest on fixed deposit. So we've got an adjustment. The interest on fixed deposit must be calculated for 6 months as the deposit was made on the 1st September 2011. The beginning of the year, your balance was 200,000 and you've got a 9% interest rate. Always remember the interest rate given to you will be the interest rate for the full year. So if you need to apportion this interest rate, you need to divide it by 12. So you've got 200,000, multiply that by 9%, divide that by 12 will give you your interest rate for 6 months. And then you've got your 6 months, the actual months that you need to account the interest for, which was 6 months, to give you your 750. In this case, interest on fixed deposit was not capitalized, which means we do not add it back into our fixed deposit account. Therefore, your journal entries would be interest income credit, so you plus on your interest income 750, and on your bank you're also adding 750. Let us look at another example. This is an example of a trading stock deficit adjustment. In this adjustment specifically, I find it easier that if you're using a T account, and the reason for this is that the adjustment amount is not given to you. Your adjustment says trading stock amounted to 89,500. That is all that was said to you. Trading stock amounted to 89,500. You do not know what to adjust. You do not know how to adjust. You do not know the value to adjust. So it's best if you have a statement that's not directly telling you what your adjustment relates to draw a T account so that you can understand what they're trying to make you achieve. So usually in a question when you're told you have stock of 89,500, that is what they're trying to tell you is how much stock do you have versus how much stock that is physically left in store. So we know that at the beginning of the year, the balance was 90,000 Rand. That was given to us. We had a closing balance of 89,500, which was also given to us. Remember from our previous adjustments, we've had drawings of 500 and we've had return stock of 840. And then adjustments for capital contribution. This is an easy adjustment. This is where the owner will contribute more money to the business. This is known as capital. So in this example, the owner deposited an amount of 20,000 to increase his capital contribution. This has not yet been recorded. So you've got your capital contribution plus 20,000 credit and bank debit 20,000 plus as well because we're going to put more money into the bank. So after you've done all your adjustments and identified your accounts, you can now complete the income statements. You can now bring down all the values on your income statement where you've had adjustments, and you can continue to adjust. Once again, it's very important to show these adjustments because these are the adjustments which are known as the adjustments done on the face of the income statements. And if you do not show these adjustments, you are likely to lose marks in the exams. Once again, just these are all the adjustments that we've gone through, and you will see that we adjusted every single amount of the transaction that we spoke about and to get to your total end value here. So today's purpose of the lesson was to ensure that you can understand how to adjust for the different type of adjustments. Remember, the key is to identify the account it is affecting and then proceed to do the adjustment, and also to remember to show these adjustments. That's all for today, guys. Thank you so much for watching. Hope you guys have learned. If you still have any questions, please feel free to drop me a mail, subscribe to our YouTube channel, follow us on Instagram, feel free to ask questions in the WhatsApp group, and most importantly, please share this initiative with all your family and friends so that everybody can benefit. Thank you once again so much for listening. Until next time, bye-bye.